Most traders believe price moves because of news, indicators, or random chance, yet they keep wondering why their entries fail and their stops are always hunted. They sense something unseen is at work, but cannot quite name it. Stand back for a moment and observe price as though it were the deliberate campaign of a single, calculating operator, accumulating quietly, advancing purposefully, and distributing without mercy. When you grasp that every swing is intentional, confusion fades. You stop reacting and begin positioning alongside the true driving force behind the market. The average trader enters the market believing price is free, spontaneous, and driven by countless independent decisions. Yet after enough losses, a darker realization settles in. Entries are punished with precision, stops are triggered to the tick, and moves unfold as though someone anticipated every reaction in advance. It begins to feel as if the market knows where you are positioned, what you expect, and exactly how to take advantage of it. This unease is not imagination. It is the natural response of anyone sensing order beneath what was assumed to be chaos. Step back from the screen for a moment, not to escape the market, but to change how you observe it. Instead of seeing thousands of competing participants, study price as though it were the deliberate operation of a single powerful operator executing a long-term business plan. Watch how advances do not erupt from excitement, but from quiet preparation. Observe how declines do not begin with panic, but with subtle failures of upward progress. This shift in perspective is the dividing line between those who react and those who understand. Markets move through campaigns. A campaign has a beginning, a middle, and an end. First comes preparation, where large interests quietly build positions while public attention is low. Next comes advancement, where price is marked upward with increasing ease, drawing participation from the crowd. Finally comes distribution, where those same large interests sell into public enthusiasm before price is allowed to decline. These stages repeat across all timeframes and across all liquid markets. Modern charts still display this structure with remarkable clarity. A prolonged sideways range following a decline is not indecision, it is inventory being accumulated. A strong breakout followed by shallow pullbacks is not luck, it is controlled upward progress. A choppy range after an extended rally is not consolidation, it is ownership changing hands from professionals to the public. Nothing meaningful happens by accident. Strong hands cannot acquire large positions without leaving footprints. They cannot distribute enormous holdings without creating telltale changes in price behavior. Volume expands at critical moments. Spreads widen or narrow in logical places. Rallies struggle when supply is present. Declines stall when demand absorbs what is offered. These are not opinions. They are observable facts. When price is treated as a campaign rather than a sequence of random candles, trading becomes a process of diagnosis. You are no longer asking, will price go up or down? You are asking, which phase of the campaign is currently unfolding? That single question reframes every decision. In today's markets, whether stocks, crypto futures, or forex, the same forces operate. Algorithms may execute orders, but intention still originates from large capital seeking favorable inventory. Technology has not altered human behavior, it has only accelerated it. Accumulation still requires time. Distribution still requires participation. Trends still emerge from preparation. Once this perspective takes hold, something remarkable happens. You stop chasing movement. You stop fearing volatility. You stop needing to be right about every fluctuation. Your focus shifts to locating where preparation is occurring and positioning accordingly. The market no longer appears hostile or unpredictable. It reveals itself as organized, purposeful, and repetitive. You are no longer attempting to outguess price. You are learning to read its story, and when you read the story correctly, you no longer feel like prey. You feel like a professional conducting business. Every trader has experienced the same bewildering moment. Price surges higher, headlines turn optimistic, social feeds explode with confidence, and just as participation feels safest, the market reverses. Stops are triggered. Positions collapse. What once appeared obvious suddenly becomes disastrous. Over time, this repetition plants a quiet doubt. If the majority sees the same bullish picture, why do they so often end up wrong? Pause and observe something subtle. Notice where optimism tends to appear. It rarely emerges near important lows. It flourishes after prolonged advances. It becomes loud when risk is actually increasing, not decreasing. This is not coincidence. It is a recurring pattern that has persisted across decades, across instruments, and across every technological evolution of trading. Large operators require liquidity. They cannot build or exit meaningful positions in silence. To sell large quantities, they need aggressive buyers. To buy large quantities, they need willing sellers. The public supplies both when properly stimulated. Therefore, emotional extremes become tools, not side effects. When institutions intend to distribute holdings, price is often pushed to new highs or near highs. Breakouts are engineered. Momentum appears strong. News aligns conveniently. This atmosphere encourages late buyers to step in, convinced they are witnessing strength. In reality, strength is being used as cover for supply. Conversely, when institutions intend to accumulate, price is often pressed lower or kept depressed. Bad news dominates discussion. Confidence evaporates. Breakdowns appear convincing. This pressure induces weak holders to sell, providing the inventory large interests quietly absorb. The crowd believes it is acting independently. In truth, it is responding predictably to price behavior that has been deliberately shaped. Modern markets still operate under this principle, even though execution is faster and structures are more complex. Algorithms now assist in delivery, but they do not replace motive. Price is still advanced to encourage buying when selling is desired. Price is still depressed to encourage selling when buying is desired. This explains why breakouts frequently fail. It explains why apparent bottoms often give way to one more sharp decline. These events are not random disappointments. They are tests designed to reveal where supply and demand truly reside. Study volume during these moments. When price rises on expanding volume but struggles to make further progress, supply is quietly overwhelming demand. When price falls on heavy volume but refuses to continue lower, demand is absorbing supply. These relationships expose intent far more reliably than headlines or indicators. Once this dynamic is understood, you stop taking emotional extremes at face value. You stop assuming that excitement equals strength or that fear equals weakness. You begin to view them as potential signals of opposite intentions. This shift in perception changes everything. Instead of asking, "What is everyone thinking?" you ask, "What must large interests be doing for price to behave this way?" You no longer feel compelled to follow the crowd. You no longer feel trapped by sudden reversals. You recognize that public enthusiasm and public despair are often necessary ingredients in professional campaigns. With this awareness, you step out of the herd. You stop being influenced by the illusion of public control. You start aligning with the force that quietly shapes it. Many traders stare at volume bars yet secretly wonder if they mean anything at all. One day volume explodes and price barely moves. Another day price runs effortlessly on modest activity. Confusion grows, doubt follows. If volume is supposed to confirm price, why does it so often seem to contradict it? This uncertainty causes many to abandon volume entirely, or worse, to use it blindly without understanding what it truly represents. Slow your observation. Volume is not noise. It is not excitement. It is not participation for its own sake. Volume is effort. Price movement is result. The relationship between the two exposes the underlying condition of supply and demand. Think of every transaction as a contest between those who wish to buy and those who wish to sell. When buyers are dominant, price advances. When sellers are dominant, price declines. But dominance is not measured by opinion, it is revealed by how much activity is required to produce movement. When price advances easily on moderate volume, demand is in control and supply is scarce. When price struggles to advance despite heavy volume, supply is present in force, absorbing every buying attempt. The market may look strong on the surface, but beneath that surface, distribution is taking place. Likewise, when price falls sharply on increasing volume, supply is aggressive and demand is weak. But when price declines on large volume and then refuses to continue lower, something important is happening. Buyers are absorbing what sellers are offering. The decline is being met with professional demand. These relationships form one of the most powerful lenses in market analysis. Modern trading platforms display volume in countless forms: histograms, profiles, heat maps, delta, footprint charts. While tools have evolved, the underlying principle has not changed. Whether you observe raw volume bars or advanced order flow metrics, the objective remains the same. Measure how much effort is being expended and what result it is producing. This perspective explains many puzzling market behaviors. It explains why a rally can appear strong yet collapse suddenly. It explains why a decline can feel endless yet stop abruptly. It explains why price often moves the farthest when activity is quiet. Professionals do not require drama to move markets. They require preparation. Once preparation is complete, price often travels with ease. When you begin to study price and volume together, you stop focusing on individual candles and start evaluating sequences. You observe whether advances are becoming easier or harder. You note whether reactions are becoming shallower or deeper. You track whether volume expands on progress and contracts on pullbacks, or the opposite. These observations tell a story. A market preparing for higher prices will show diminishing volume on declines and expanding volume on advances. A market preparing for lower prices will show diminishing volume on rallies and expanding volume on declines. Nothing here depends on prediction. Nothing depends on complex indicators. It depends on interpretation. Once this understanding settles in, confusion fades. You stop asking why price did not move, or enough. You stop assuming high volume means strength or low volume means weakness. You start seeing volume as a measuring instrument, not a signal generator. The market becomes less mysterious. Price and volume speak a clear language, and when you learn to read that language, you no longer feel lost. You feel oriented. You feel prepared. You feel in control of your decision-making process. Most traders search for opportunity in motion. They chase breakouts, momentum candles, and sudden expansions in price, believing that activity itself signals profit. Yet again and again, these moments become traps. Breakouts fail, momentum fades. Price returns to where it came from, leaving behind frustration and disbelief. It begins to feel as though opportunity appears only long enough to punish those who try to seize it. Resist the urge to chase movement. Instead, study stillness. Markets spend far more time preparing than advancing. The greatest campaigns are not launched in obvious fashion. They are constructed quietly, patiently, and often invisibly to the untrained eye. When price moves sideways, the public assumes nothing is happening. In reality, this is where the most important business is conducted. Large operators cannot acquire significant positions during vertical advances. Doing so would drive price against themselves. They require time and balance. They require an environment where buying and selling can occur without revealing intent. That environment is the trading range. Inside these ranges, ownership is changing hands. Weak holders are surrendering positions. Strong hands are absorbing inventory. Price oscillates not because of randomness, but because opposing forces are being methodically resolved. The same principle applies near market tops. After an extended advance, price often stops trending and begins moving sideways. To the public, this looks like consolidation before another rally. To the informed observer, It often represents distribution. Professionals are selling into demand while maintaining the appearance of strength. Modern markets display these structures constantly. Whether on a 5-minute chart or a weekly chart, ranges form, persist, and eventually resolve. The time frame changes, the logic does not. The key is not merely identifying a range, but interpreting its character. Watch how price behaves near the lower boundary. Does selling pressure diminish? Do declines become shorter? Does volume contract? These are signs of absorption. Watch how price behaves near the upper boundary. Do rallies struggle? Does volume expand on advances but price fails to progress? These are signs of supply. Ranges are laboratories. They reveal who is in control. A range dominated by absorption eventually resolves higher. A range dominated by supply eventually resolves lower. This is why professionals focus their analysis inside congestion rather than after breakouts. By the time price escapes a range, the majority of the opportunity has already been created. When you begin to study trading ranges in this manner, patience replaces urgency. You no longer feel compelled to act simply because price is moving. You wait for evidence that preparation is complete. You stop asking, is price going up or down? You start asking, is inventory being built or released? This shift transforms your relationship with the market. Sideways action no longer feels like wasted time. It becomes valuable information. You realize that the quiet phases contain the loudest clues. Eventually, a moment arrives when price begins to move with ease. Pullbacks become shallow. Progress becomes steady. Breakouts hold instead of failing. These are not accidents. They are the natural outcome of work completed earlier. When you recognize that accumulation and distribution hide in plain sight, you stop being surprised by trends, you stop being late, you stop being shaken out. You find yourself entering when risk is low and potential is high. And in that moment, the market stops feeling like a battlefield. It feels like a business. There are moments when price suddenly breaks support and triggers a wave of panic. Stops are hit in rapid succession, traders abandon positions, confidence collapses. Then, almost without warning, price reverses and surges higher, leaving behind confusion and regret. The same phenomenon appears near highs, where price briefly breaks out, lures in eager buyers, and then violently collapses. These experiences convince many that markets are cruel, unpredictable, and intentionally designed to inflict pain. Observe these episodes more carefully. They are not accidents. They are examinations. Large interests do not commit capital blindly. Before launching a sustained move, they must determine whether opposing supply or demand remains. The only reliable way to uncover this information is to provoke a response. When price is driven below support and quickly recovers, it reveals something vital: sellers are no longer in control. Supply has been exhausted or absorbed. The sudden decline was not weakness. It was a probe. When price is pushed above resistance and rapidly fails, it reveals the opposite: buyers lack staying power. Demand is insufficient. The apparent breakout was not strength. It was a probe. These maneuvers are designed to mislead those who interpret price mechanically. To the uninformed eye, a breakdown signals continuation lower. To the informed eye, a false breakdown that snaps back signals preparation for higher prices. The same logic applies at tops. A false breakout above resistance that quickly collapses signals preparation for lower prices. Modern markets perform these tests constantly. Algorithms accelerate the process, but they do not change the purpose. Liquidity must be located. Weak hands must be identified. Stops must be triggered to expose where orders reside. This is why markets often move in ways that appear irrational. In truth, they are extremely rational when viewed from the perspective of inventory management. Price is not moved to reward honesty. Price is moved to discover commitment. Study how price behaves after these probes. Does a downward thrust produce heavy volume yet fail to continue lower? That suggests strong hands are absorbing supply. Does an upward thrust attract heavy buying but fail to hold higher ground? That suggests strong hands are distributing into demand. The aftermath matters more than the event itself. Many traders focus on the spike. Professionals focus on the response. When a market is preparing for higher prices, tests lower tend to become shallower and shorter. Recoveries become faster. Pullbacks lose depth. When a market is preparing for lower prices, tests higher tend to become weaker and shorter. Failures occur quickly. Rallies lose power. These subtle changes reveal the dominant force. Once you begin to recognize tests for what they are, your behavior changes. You stop selling in panic after a sudden flush. You stop buying in excitement after a sudden breakout. You wait to see whether price accepts or rejects the new level. This waiting is not hesitation. It is discipline. It is observation. It is professional conduct. Over time, these tests become welcome rather than frightening. They provide clarity. They reveal the hand behind the curtain. You no longer feel ambushed by false moves. You expect them. You understand their purpose. And with that understanding, you find yourself entering alongside strength that has already proven itself. The market stops feeling deceptive. It starts feeling logical, predictable in its structure, honest in its intent. And that realization brings a calm confidence that no indicator can provide. Most traders approach the market as if their primary task is to forecast what will happen next. They search endlessly for indicators, news catalysts, and opinions that promise certainty. Yet despite all this effort, outcomes remain inconsistent. Predictions fail. Confidence erodes. A quiet frustration emerges from realizing that being right about direction does not always translate into profitability. Step away from prediction. Shift your focus from foresight to synchronization. The market does not reward those who guess correctly. It rewards those who act in harmony with the dominant force at work. There is always a controlling side in the market. Sometimes it is demand, sometimes it is supply. The objective of the professional is not to anticipate which side will appear tomorrow, but to recognize which side is already in control today. Price, volume, and structure reveal this information continuously. When advances travel farther and faster than declines, demand is dominant. When declines travel farther and faster than advances, supply is dominant. When pullbacks are shallow and volume contracts, upward movement is favored. When rallies are weak and volume contracts, downward movement is favored. These are not predictions, they are observations. Modern trading environments tempt participants to overcomplicate decision-making. Dozens of indicators can be layered onto charts. Complex strategies promise mechanical precision. Yet beneath all complexity, the market still operates on the same foundation imbalance between buyers and sellers. The professional simplifies. He observes whether progress is becoming easier or harder. He observes whether reactions are being absorbed or extended. He observes whether price respects support or fails at resistance. From these observations, alignment emerges naturally. This alignment removes the emotional burden of being right. You no longer need to call tops. You no longer need to call bottoms. You participate when conditions favor movement in one direction and stand aside when they do not. This approach transforms risk management. Instead of placing stops based on hope, they are placed at logical points where your interpretation would be invalidated. Instead of holding positions because of opinion, positions are held as long as behavior remains consistent with your premise. When behavior changes, you exit without debate. This is professional conduct. It mirrors how large operators conduct business. They do not argue with price. They do not cling to narratives. They adapt. Alignment also brings timing. You find yourself entering during quiet pullbacks rather than emotional surges. You find yourself exiting into strength rather than weakness. You find yourself comfortable being early within a developing structure and absent when conditions deteriorate. Gradually, trading stops feeling like a contest of intelligence. it starts feeling like pattern recognition. You are no longer trying to outsmart the market. You are listening to it. And the market speaks clearly to those who are willing to observe without bias. With this shift, pressure dissolves. You are not responsible for knowing the future. You are responsible for reading the present. That responsibility is manageable, repeatable, professional. And in that realization, a deep sense of calm replaces the chaos that once defined your trading. You are no longer chasing certainty. You are operating in alignment with reality. The market is not random, nor is it designed to punish traders arbitrarily. It operates with intention, structure, and repetition. Price moves are campaigns, carefully orchestrated sequences of accumulation, advancement, distribution, and testing. Large interests leave footprints in volume, spreads, and reactions. They shape participation and provoke responses to reveal supply and demand. True trading mastery does not come from prediction, chasing momentum, or relying on indicators. It comes from observation, interpretation, and alignment with the dominant force at work. By studying price, volume, structure, and context, you stop reacting emotionally and start acting strategically. You learn to read the market's story, recognize professional campaigns, and participate when risk is favorable. In this approach, uncertainty becomes manageable, volatility becomes information, and the market transforms from a battlefield into a business. You no longer fight price, you understand it, respect it, and move in harmony with it. That is the foundation of professional trading: clarity, discipline, and alignment with the forces that quietly drive every market.